How are you all doing on this Sunday afternoon?
All good, Sakshi. Thank you for asking.
Great. So I believe 12 of us are here. So should we start or should we wait for like 2-3 more minutes? Because Karan, how many people are there? Like total participants?
There are 22 to 25 candidates. Okay, you have to wait for 5 to 10 minutes only. Okay.
Yeah. Okay. So meanwhile, how was yesterday's session? I believe you all studied about some principles of accounting yesterday. So is there anything that I need to take up from yesterday's session, like any of your doubts or anything you are looking for more clarity upon, or everything is clear and we should go ahead?
I think Neha, yesterday's session was good, and from my side it was clear. So
Okay, great. Anybody else? Anything meanwhile we can talk about, like till the time other people join in? Or else we'll just start afresh with this specific financial items session.
Am I audible?
Yes.
Ma'am, actually, I wasn't able to attend yesterday's class. So could you please just give me some bullet points on what all things you discussed yesterday? Just point.
So
Point.
as in,
Yes.
I think yesterday's session was like a very detailed one. It's very difficult to give you bullet points because yesterday, I believe those three golden rules of accounting must have been
Yeah.
discussed in and all the accounting concepts and conventions, including going concern and accrual basis and everything.
Yeah.
Then
Yeah. Yeah. All right. Mhm.
yeah, so all of that must have been
Okay.
discussed yesterday.
Introduction to accounting, basically.
Sort of, and
Mhm.
those principles of accounting in detail. So yeah, posting journal entries, using those rules of accounting to post journal entries, that sort.
Mhm. All right. So I'll just go through the recorded video. Thanks. Thank you.
Yeah, sure. So I believe let's start now. and I'll try to keep the things slow in the beginning so that if anybody else joins in further like 5-10 minutes, they are also able to catch up. Okay. So yeah, today's session is about specific financial items. So I'm going to take you through some major of the balance sheet and P&L items. Okay, so broadly, I'll discuss the tangible and intangible assets, depreciation, investments, inventory, working capital, deferred taxes, contingent liability, equity, revenues, and expenses. Okay, so I'm going to touch upon these topics and try to explain it to you with examples, and wherever possible, I'll try to, use number examples as well. But wherever you think that you have not got a grab on to these things, these concepts, or the way I'm explaining, please stop me there. I'll try to explain it further, okay? Because these are the basic topics that you should know. So just to have an idea about my audience, how many of you are from commerce background and already know these topics? And how many of you are there who are very new to this? Like, you must have heard about the terms, but you're not aware of the details and everything. So I know that in how much depth I need to explain. You guys can type also.
Yeah. Hi, Sakshi. I'm Nalin.
Yeah.
Okay, I am from the engineering background,
Okay.
so it's completely new for me. Yes, I'm into business, sales, and marketing. So I've heard about things, but I want to
Yeah.
learn further in detail.
Yeah. Okay. Okay. Great. Okay. So in the chat box, I can see many of us are from commerce background as well. So yeah. Okay. But for those who are not from commerce background, okay, for you people, I'm specifically asking, just stop me wherever you are having a confusion, or you don't have a clear, crisp knowledge about these topics and want me to explain further. Okay. Okay, so many people are here from commerce background. Great. Okay, so yesterday, did you guys look at a sample balance sheet? And like, you know what a balance sheet is? The assets, liabilities. Yes?
Yes.
Great. So you know what a balance sheet is, right? It shows the balances as on a date. Your asset balances as well as your liabilities balances. So that is why it's called a balance sheet, or you can call it a statement of financial position. Yeah. Yeah. Okay. So here you can see that we are talking about some of the strengths and weaknesses of a balance sheet. Okay. So strengths. How do I minimize this? I'll have to look at the chat box as well, right? Where do I go for that? Just give me a moment. I'm just trying to open the chat box side by side so that whatever you guys are writing in it, I can look at that. Okay. Yeah, done. Okay. So talking about the strengths and weaknesses of a balance sheet. So in strengths, we are talking about that these financial statements or balance sheet along with P&L, they give an insight for shareholders, cross-checking the accounting process, monitoring liabilities, limited indication of profitability. How do you think these are the strengths of a balance sheet? Or we can also say that these are the basic purposes that a balance sheet should solve, right? It should give an insight for shareholders. Why? Because looking at a balance sheet, you should be able to understand the financial position. Yes. How much are the assets? How much are the liabilities? This should give an insight to those who are the stakeholders, not just shareholders, but all the stakeholders. Did you read or did you study about the users of financial statements yesterday? Can you name a few? Who are the users of a balance sheet, P&L, or let's say financial statements?
Shareholders, investors,
Yeah, yeah,
and the other companies who are the competitors. They also check.
yeah. They are peers. Then your customers, your
Yeah,
vendors,
yeah, vendor.
the
Yeah,
government. Yes, you need to file your financial statements with government. Yes, taxation authorities.
yeah,
Yes, so these all are the users of financial statement. So when we say the strengths and weaknesses, we mean that the strengths and weaknesses from the point of view of stakeholders, right? So these financial statements should be able to give you a clear picture of the financial position of that business, organization, company, whatever. Yeah. Then you should be able to cross-check the accounting process also. So as you know that there are standards which are there in accordance to which the financial statements should be prepared, right? So there are specific standards which lay down the foundation or the basic accounting that should be followed by all the organizations. Right. So if you are looking at financial statements, you should be able to understand that whether the prevalent standards, the guidelines, or the rules have been followed or not, and the accounting is actually correct or not. Yes. So that is one of the main purposes that a balance sheet or the financial statements should solve. Monitoring liabilities. Yes. So a balance sheet shows the balances of assets as well as liabilities. So you should be able to look at the liabilities also. Yeah. So for example, you're looking at the balance sheet. Okay. And you can see that there is a huge debt for the company. And you can see that not much of the current assets or liquid assets are there to pay off the current liabilities related to that debt. Okay. Or you can say that the amount of property, plant and equipment as well as the debt is more or less equivalent. So you will see that, okay, the more the debt is, the more of that amount of property, plant and equipment is also mortgaged. Yeah. So the company is not having any free assets to use. Everything is mortgaged. So even if the company defaults, so those assets might go away, and then there is a huge probability that the business might have to be shut down. Yeah. So all these things you should be able to understand from financial statements. The limited indication of profitability. So yeah, if you are reading the financial statements, you are able to analyze them. Yeah, you will be able to get a grab onto the profitability that the company is looking up to. What is the book value? What is the worth of that company in the market? Okay, how much assets they have, how much liabilities they have, how many customers, what is the amount of receivables they are having, that sort. Yeah. So when we talk about strengths, there are also some weaknesses of a balance sheet. Major of that is about the off balance sheet items. Do you understand what are off balance sheet items? Any example that you can think of that what are off balance sheet items?
Letter of credit, commitments.
Mm-hmm. Yeah. Yes, you are right. Any more examples? Anybody else? No. So yeah, commitments. Another example is the leases. Yeah, so lease is not there in the balance sheet. If it's an operating lease, you will see that there is nothing that you can see in the balance sheet. Only the rental expense is recorded as an expense, right? So these are off balance sheet items. So consider a situation where a business is running, having only one property, which is there on lease only. Okay. And it is so crucial to have that building that all the other like machinery and other stuff is there in that building only, but that building is on lease. Okay, and it's on operating lease. Since it's on operating lease, there must be a fixed term to it. Okay, and there are chances that you might have to leave that building also. Practically, whatever happens is another topic. But if it's an operating lease, there are chances that the lease might end one day. Technically, you might be asked to leave that building also. Okay, and that important aspect is not there on the balance sheet. So none of your stakeholders can read, or they will not be able to know about its importance. There is only one item in the P&L by the name of rent expense. That's it. Okay, so, and like commitments, right? You might be having some huge commitments, but since these are commitments, they don't have any of the amounts recorded in the balance sheet as of now. It's very much important to be disclosed, but since it's not in the balance sheet, yeah, so balance sheet is not actually reflecting a true picture. So yeah, that's a weakness. Another thing is about the valuations. Okay, so like that a balance sheet is actually showing the balances of assets and liabilities on one date. Okay, and there are several guidelines, standards, rules in place in accordance to which you are required to measure your assets and liabilities. Okay, so at times, or mostly I would say, it's on cost. Cost is historical cost, right? The amount that you must have paid, all the costs that you might have incurred for bringing those assets in place or liabilities be incurred. At that amount, your assets and liabilities must have been recorded in the balance sheet. However, on the date when somebody is reading your financial statements, that asset or liabilities value might have changed, right? So that's a limitation of a balance sheet. Again, mark to market is the same thing, that it's not valued as per market, so that's not the fair value. It's only the cost that is recorded in the balance sheet. Fair? Any question?
Yeah, Sakshi, just one thing.
Yeah.
When we know there are weaknesses, so is there anybody who's working to improve it, or bringing about a new change into the system, or a regime change?
Yeah, so fair question. So let me tell you, or let me highlight one thing here, that the discussion that I am doing here is on Indian GAAP basis. Okay.
Okay.
And when you talk about IFRS or Ind AS, they have a different perspective. So if I talk about IFRS or Ind AS, this off-balance sheet issue has already been addressed there. Okay.
In which
So
one?
if
In which one?
Ind AS or IFRS, you know IFRS, right?
Yeah, yesterday we got a good glimpse of it.
Okay, so I'll tell you a bit more about it so that you're able to understand. So what happens is, like I said, so I was generally telling you guys, not mentioning Indian GAAP or IFRS or Ind AS, not to confuse you. So what happens is, there are these guidelines which are prescribed by for every country. They are specific. Okay, so for Indian GAAP, we will say that these are the generally accepted accounting principles in India. Okay, so there will be like several kinds of gaps. Wherever you go, you will have a Dutch gap, you will have a US gap, you will have Indian gap, Nepal gap, whatever gap. Okay, so gaps are generally accepted accounting principles for that specific country. So we have Indian gap here. Okay, then there are IFRS. IFRS are International Financial Reporting Standards, which are the same globally. So in US, if somebody is using IFRS, and if India somebody is using IFRS, that will be same. They will use the same principles which are there in IFRS, which have been, discussed in IFRS. They'll be using the same principles to report their numbers. But if somebody is following US GAAP and somebody is following Indian GAAP, those two will be different.
These weaknesses which are shown out here are in the Indian GAAP or in the GAAP system itself?
So we are talking about Indian GAAP. So this is Indian GAAP. that I'm telling you. If I talk about
Okay.
IFRS, yeah, so if I talk about IFRS, or I would talk about Ind AS. Do you know what is Ind AS?
No.
Okay, so Ind AS is IFRS converged to Indian needs. Okay, so we have not just adopted IFRS, we have converged to IFRS, meaning that we have not used the IFRS as it is. We have made certain, changes to IFRS to suit it to Indian economy. So it's a thing
Okay.
between Indian GAAP and IFRS. So that's why we call them Ind AS.
Can you please spell it again?
I'll type it.
Yeah, please. Thank you.
Okay.
Okay. Ind AS. Okay.
Yeah, Ind AS. Okay, and we say Ind AS. And Ind AS is different. So don't confuse them with Indian accounting standards. Okay. So AS is different.
Mm-hmm.
Ind AS is different. IFRS is different. Okay. So let me tell you from Ind AS or IFRS perspective that these off-balance sheet items issue has already been ruled out there. Okay, so in Ind AS and in IFRS, you're actually required to show these amounts in your balance sheet. So for example, when I talk about lease, what happens is that for an operating lease, you're actually required to show the amount of that lease. There is a calculation. I'll not confuse you by telling you that in detail. So what you do is you calculate the total amount which is payable in an operating lease. Suppose it's a 10-year lease. Okay, so the total amount of lease payments that you're required to make in that lease agreement, you're actually supposed to calculate that total amount, show that as your liability, and show an asset also equivalent to that amount in your balance sheet. We call that ROU.
Is it like we show it as an outstanding debt that you're clearing with time, and in income we show the every payment that we keep doing every like?
Yes,
Okay.
precisely. Okay, so because your balance sheet should actually not have a hit now. So that is why an equivalent amount is shown in asset as well as liability.
Okay.
But with this, but by doing this, you have actually brought an off-balance sheet item in your balance sheet. So it's visible now.
How do you?
I have one question.
Yeah.
Hello.
Yes, yes.
Actually, if my business is working, is like lease business. If, for example, my company is working as a lease business, and I have taken so many lease from vendor, then I just provide to customer for leasing. Okay. So how can I treat the actual liability and asset? So how can I treat the accounting if my business is basically lease business?
So you're saying you're into a business of lease only. I am talking about lease that I have taken. So you're saying you have taken maybe land or maybe buildings or something or maybe other assets on lease only.
Yes. Yes.
You have taken on lease and then you are further giving them on lease. That's what you're saying.
Yeah. Yeah.
Yeah. So you're into business of leasing.
Leasing.
So
Right.
even in that situation, you'll have to see what are these leases, like finance leases or operating leases. So for operating leases, you will have to do the same. ROU asset and ROU liability. In Ind AS or IFRS. In Indian GAAP, you're not required to do this.
So how can I show my balance sheet to a investor and any shareholder that my business is working that kind of work, leasing business? Okay. And
Yeah.
how can I show that balance sheet?
That's what I'm saying, that I'm
because
not.
it's a weakness. It's a weakness of balance sheet that we can't provide the actual leasing, what we have taken leasing from the vendor, and what is the exact liability in our side. So it's a difference in this leasing business sector.
No, so I'm saying that if you have taken a lease, which is finance lease, so anyway you will record an asset and liability. So you know how do you deal with finance leases?
Yes. For
Yeah.
example, if my business is like leasing business, okay, I have
Yeah.
taken one building, entire building for 1 year, and
Hmm.
now what I do that
Hmm.
I just provide to customer for
Hmm.
leasing that
Yeah.
for 1 year, okay,
ठीक है.
and I have taken rent from customer monthly basis,
ठीक
okay,
है.
and
Hmm.
but I have already also I have provided the rent for monthly basis to vendor. Okay,
Hmm.
but
Hmm.
the thing is that if I have so many leases I have taken, you know, the business we can
Hmm.
one of the startup company
Hmm.
who is taking just is providing just leasing to the customer. So
Hmm.
if I want to just show my business in my balance sheet, but
Hmm.
if I already agreement in customer that I have taken already one year of business, but my business is not working good, and my 3 and 4 floor has been just empty. It means nothing, any business, and only 2 and 3 floor has working. So I'm not, just I'm getting 3 and 4 floor. Just I'm getting rent from fourth floor, and third floor I am not getting any rent. But my lease has been for 1 year. So how can I treat this accounting?
So two things. Firstly, this is a short-term lease that you're telling me. Okay, if your lease is like for 1 year only, you're not required to do this accounting. You're not required to do the ROU asset and ROU liability for a short-term lease. Okay, first thing. Secondly, how your business is doing, or you're a startup, or you have suppose 100 leases, that will not stop you from doing the correct accounting. Even if you have to calculate ROU asset and liability for 100 assets, you will have to do it, even if you're a startup or if your business is not doing good. That doesn't really matter.
Okay.
Yeah. So even if you have 100 leases or 200 leases, it doesn't really matter. You will have to still do that kind of accounting. But yeah, this standard Ind AS 116, it exempts you from doing this accounting or doing all of this effort for short-term leases. So short-term leases are exempt. Okay. So for 1 year lease example that you're giving me, you're not supposed to do this. Short-term leases as well as immaterial amounts. Okay. Hello. Am I audible? Hello?
Yes, you are audible.
Yes.
Yes, ma'am.
Okay. Who asked that question? I mean, um, sorry, I couldn't get your name. Is it okay
Sushant.
now, or do you need any
Yeah.
more clarification?
Yeah, ma'am. Yeah.
Okay. So should we move forward?
Just one thing,
Yeah.
Sakshi, what does ROU stand
Yeah.
for?
ROU is, let me type it out for you. It's right of use.
Right of use.
Yeah, because it's an operating lease. It's not a finance lease. So you're only getting a right of use. You don't own that asset.
Yes. Okay, great. Thank you so much.
ROU asset and ROU liability.
Great. Thank you.
Okay. Great. So now that we talked about some of the benefits as well as some of the limitations of financial statements, there is a crucial thing that you should understand. The difference between standalone versus a consolidated financial statement. So any ideas that you have about a standalone or consolidated financial statement?
Standalone is like when you do not take into consideration your other subsidiaries or parent company's financial statements, but you just prepare your own company's financial statements. While
Yeah.
consolidated would be when you take every subsidiary you have and every parent company, consolidate a balance sheet with them and then present it.
Perfect. Perfect. So yes, that's the difference between a standalone and a consolidated financial statement. So for those of you who are not from commerce background, let me tell you that companies and groups of companies are actually structured in a lot of ways. Okay. So there are subsidiaries, there are associates, there are joint ventures. I'm sure you must have heard about all these terms, and there will be a separate session for discussing all these topics in detail. Right now, let me just tell you that a parent company can have a subsidiary, can have a lot of subsidiaries, associates, or joint ventures. Okay, and together, all of these companies form a group. Okay, so if I say that there is a company A, okay, and there is a subsidiary company B, there is an associate C, and a joint venture D. So all of these A, B, C, D, 4 companies are actually required to prepare their financial statements. So their separate or individual financial statements will be called a standalone financial statement. So A will prepare its own financial statement, not thinking about any of its subsidiary, associate, or JV. That will be called a standalone financial statement. Similarly, B, C, and D are also required to prepare their own financial statements. So they are standalone financial statements. But what would be a consolidated financial statement? A's financial statement taking into account the numbers of B, C, and D. That will be called A's consolidated financial statement. Fair enough? This is the major difference, or a simple explanation of what a standalone versus a consolidated financial statement means. Okay, let's read through the slide also, and then let's try to understand it further in detail. So like I said, huge corporations organize their business as several different companies. Yeah, so if there is a company and it means to actually open a different company now for another business or in a different region, it might open a separate company, or it might open a parent company's subsidiary, associate, or JV. Each of the individual companies is controlled by a parent company. Parent company presents standalone financial statements and consolidated financial statements. Yeah, so only A's consolidated financial statement will be there. B, C, and D cannot make any consolidated financial statements because they are not the parent companies. Parent is A. So only A's consolidated financial statement will be there. Standalone financial statements reflect only the transactions of parent company and ignore the transactions of subsidiaries. Consolidated financial statement treat the entire group as one. That's what we talked about. Yeah. So while looking at the financial statements for any company, you should be first looking at whether you're looking at a consolidated financial statement or a standalone one, and then only you should proceed to analyze it. Make sense?
So can we say which one is better?
Which one is better?
Yeah.
There is nothing as better. I mean, better in what sense you're talking about? For your
Like
analysis?
while analysis, which one should we prefer more?
Depends on whose analysis you are depending upon. If you're looking at the individual company, so for what purpose your analysis is, that only will make the difference. Suppose you're making an investment as an individual, suppose you're thinking that whether this company is doing good or not, I should go ahead to invest my money into this company or not. I believe it's better to look at it as a whole at the group level and at the consolidated level. because all these companies are interrelated. Even if one falls down, another will be there to help it out. I believe it, but there is no such thing that we can say that it is better or not. It totally depends on what kind of analysis you are doing.
Okay.
Yeah, so standalone is standalone. Okay, if one company is there and you need to actually just look at that company, it totally depends on what purpose you are looking at, right? And if you actually want to look at how the group as a total is doing, you should definitely look at the consolidated financial statements.
Okay. Okay.
Okay. So next up, we're gonna pick up some of the major balance sheet items. Okay. First, let's talk about goodwill. So what do you understand by goodwill? Guys, goodwill. Repo in the market. Nice. Anybody else?
Which we paid for a business.
Whoever is talking, your volume is like very low. Can't hear you.
It's an intangible assets.
Mm-hmm. Yes, it is an intangible asset. Assets that are not separately identifiable, credibility. Okay, so most of us have actually an idea what is goodwill, position of the company in the market. Right. So by the literal meaning of the term goodwill, we definitely understand that, we're talking about some credibility. We're talking about what position that company has in the market, what is its repo, right? So we are actually talking about. So, but when we say goodwill in a balance sheet, how do you think you're going to measure it in number terms? When we say credibility, or when we say that the position of that company in the market or the report of that company, how do you think we're going to calculate it in number terms and record it in balance sheet?
Like it is an intangible asset. So
Yeah,
we take it, yeah. So we take it like that in the balance sheet.
but what amount?
Can you repeat the question?
I'm saying that we all understand the meaning of the term goodwill. Okay. But when we talk about it in a balance sheet term, how do you think we should record goodwill? What amount can be calculated? How actually can you calculate the amount of goodwill?
Yeah,
How
it
do you assign
calculated
it?
by market price. It calculated by market price. At that time, what is the market price of our business? What, matlab,
Like the valuation that we do of our company and the market price right now, the difference between them would be the goodwill amount.
Okay. Okay. So two important points here. Okay. Firstly, now we all know that goodwill is an intangible asset. Okay. So every time, always keep it in mind that internally generated goodwill is never recorded in a balance sheet. Okay. Take it for ground rule. Internally generated goodwill is never recorded in a balance sheet. Okay, so whatever your company has a valuation in the market, or you're having a lot of customers, you're having a lot of following on social media accounts, doesn't really matter. You can never record the internally generated goodwill. Never. Okay, so the only goodwill that can be recorded is the purchased goodwill. Okay, And how do you calculate purchased goodwill? It refers to the amount paid for an acquisition that is over and above the fair value of an asset. Okay, so for that purpose, actually the valuation thing comes into picture. Okay, so suppose you have purchased a company, or suppose you have purchased all the assets of a company. Okay, asset acquisition maybe, or business acquisition maybe. So suppose you got valuation done for that business, and that actually came out to be 80 rupees. But you have actually agreed to pay 100 rupees for that business. Okay, so the goodwill would be 100 minus 80. That 20 rupees that you have actually paid over and above that fair value of 80 rupees is the goodwill. That is how you can assign value to goodwill for a purchased goodwill only. Okay, because internally generated is anyway not recorded. So if you're purchasing an asset, purchasing a company, and for that if you have paid something over and above the fair value of that asset, that actual extra amount is the goodwill that you have paid for. Okay, and think of yourself as a genuine businessman who actually knows that the valuation is actually 80 rupees, but this company has way more value than the number net worth. Maybe there is a good repo in the market. Maybe that company is located in a very good area that gives an edge above other competitors. So for that actual extra advantage, you will pay extra. Otherwise, why would you pay anything over and above the fair value? Right? Make sense? What does internally generated goodwill mean? So internally generated goodwill would mean that for yourself, suppose you are having a very good standing in the market, or suppose you're having a location advantage over your other competitors, and actually your balance sheet does not reflect the true value of that advantage, of that, or that good repo that you have in the market, or that good standing with the lenders or with your customers that you have. Suppose your balance sheet is not actually reflecting that. Okay, so your competitors or your investors might actually be be willing to pay extra to acquire your company. So there are several ways to understand that what kind of goodwill you have in the market or your industry, right? So in our example, suppose your business is actually having rupees 80 valuation, okay, and your investors are actually going to pay you 100 rupees to acquire, or your competitor is actually wanting to acquire your company for 100 rupees. So that 20 is actually goodwill, but that's internally generated. You have not purchased it. You have made that on your own. Your company has internally generated that goodwill in the market. Okay, so that is internally generated goodwill, but you don't record that internally generated goodwill in your books. Okay, so I told you two important points. One, internally generated goodwill is not recorded. Secondly, purchased goodwill is calculated and recorded. Okay, how is it calculated? It's the extra amount that you pay over and above the fair value of the asset. It's a mutual agreement between two party. Agreement to what? Sorry. You might unmute yourself also. Goodwill value. It's a mutual agreement between two parties. Yeah, it's a mutual agreement between two parties. Definitely. So you can get the valuation done in the market, but whatever the other person is going to pay over and above that valuation or that fair valuation is definitely an agreement between two parties. That's why negotiations are there, right? That's where negotiations come into place. Okay.
Sakshi,
Yeah.
Okay, goodwill, it should not means every time goodwill should not be there, right? With every transaction that happened between two
Yes.
parties,
Yes. I was coming.
it may be. Okay, sorry.
Give me a moment. Let me, let me proceed. And then even if it's not clarified, then let's come back to your question. Okay. Yeah. So I was saying that I told you two important points. Third important point is that goodwill is not depreciated. Okay. So in Indian GAAP, actually goodwill is depreciated. So there is a difference in India's IFRS and Indian GAAP. So as per Indian GAAP, goodwill is actually depreciated, taking some standard life. But in India's and IFRS, we actually don't depreciate goodwill. Okay, so the amount of goodwill that has been recorded in a balance sheet, it will remain as such. Fourth important point is about goodwill is that sometimes you might not actually have goodwill. The transaction might go in a different direction. Suppose actually you have that kind of asset base or liability or customer base or investors or investment base that actually your valuation of business is higher than a competitor or investor might be willing to pay. Okay, maybe because you don't have that good kind of advantage, or other people are doing good, maybe your technology is not good, or maybe over the time, even with so many years in the business, you have not been able to make a place for yourself or your company in the industry. Any reason could be there. Okay, so the transaction might go in opposite direction also. Suppose the valuation is 80 rupees and your competitor, your investor is actually willing to pay you only 60. They are not even willing to pay you to your net worth. They are not going to pay you to 80 rupees also for your business, so that you have a neck to neck transaction. Okay, so negative goodwill can be there, right? If you will calculate, you will see 60 minus 80, right? There'll be a minus 20 goodwill. So that negative goodwill is actually called a bargain purchase. And you record that amount as capital reserve. Okay, so goodwill is recorded on the asset side. Capital reserve is actually recorded on the liability side. Make sense? Any question now?
Just one question, Sakshi.
Yeah.
You said about the goodwill will be negative and we'll call that as a bargain purchase and it will be shown on capital reserve. But when we see the financial statement, in that the goodwill will be in negative only. They
No, no,
won't
no, 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 no. I'm saying, so I'm talking in goodwill terms only. So what I can also do is I can say goodwill oblique capital reserve.
Okay. Okay.
Okay, so you don't record a negative goodwill. I'm just saying that if you are using the same formula, you will get a negative goodwill. So you don't actually record a negative goodwill. You actually record it as capital reserve, and that will be on the liability side.
Ma'am,
Yeah.
ma'am, but some companies in every financial year, some amount is preserved as capital reserve. What is this?
That's general reserve, not capital reserve.
What is the difference between capital reserve and general reserve?
So capital reserve is actually, I just told you that the bargain purchase, in a bargain purchase, you will not even pay the amount of fair value of that asset. You will pay less than that. Okay, so the saving that you made in acquiring that asset, that is actually the capital reserve. While you are talking about general reserve, it's just like retained earnings. General reserve is only a kind of retained earnings. Those are free reserves. So what companies do, they earmark some of their profits to be used as general reserve or for any kind of upcoming huge repair, maintenance or something. So they try to make a reserve for that. So they call it a general reserve. That's it. General reserve is very it's like a free reserve. You can use it for any purpose. Capital reserve is not there to be used as a free reserve. It's just termed as a reserve. It's not actually a reserve. It's just like good. It will be there in your balance sheet.
Ma'am, if there is a loss in a financial year, where is good situated in general reserve or capital reserve?
No, it will not go to general reserve or capital reserve. I'm saying if you have a loss, it will be there in the equity. So we'll come to that. Let me proceed further. Yeah,
Okay.
so we'll go there. When we talk about retained earnings, you'll get your answers. Okay. Anything else related to goodwill or capital reserve? Okay. Okay, great. I'm hoping that I'm very much clear and you people are not giving up on me. Just let me know wherever I'm not clear. I'll try to explain it further. Okay, so next up, let's discuss about deferred tax assets and liabilities. So any ideas that you have about deferred tax asset, liability?
Deferred tax assets means the income which is gain in future, and deferred tax liability is the liability which will occur in future, which is not recognized right now. It will be in future.
Yes.
We have make provisions like lawyer fee. Sometime it was also not it was not मतलब अभी अपन लॉयर की फी अभी मतलब नहीं समझ सकते कि इतनी लगेगी, तो वो डिफर टैक्स हो अपने लिए, अपने के बाद में कितना आएगा वो अमाउंट, एक्सपेंस रिलेटेड.
Okay, so the example actually you gave is about contingent liability, not deferred tax liability. Okay, so I'll explain the deferred tax asset liability thing and the contingent liability thing also. It's there in our content further. Anybody else about deferred tax asset or liability?
So it's like balance sheet deferred tax assets we use for reducing the taxable income in the balance sheet for future. And liability, it's like we know it what we are going to pay, and before that only we are preparing it. I'm not sure on liability. I know about the tax
No worries.
assets.
Okay, so let me explain. So what happens? Guys, you can please put yourself on mute. Thank you. Okay, so what happens is that when you are running a business, you are actually preparing your financial statements, your books of account in accordance with the Companies Act. Okay, so in India, Companies Act actually specifies the kind of accounting that you're required to do. Okay, and then there are tax authorities also. There is an income tax act also, and there is a Companies Act also. Okay, so the books of account or the financial statements that they are actually making are in accordance with the Companies Act. Okay, and when you are actually required to file your returns, your financial statements, you are actually required to prepare a parallel set of books of account as per Income Tax Act also. Okay, so you might have heard that some expenses are allowed as per Income Tax Act, some are disallowed, right? There are deductions that are given. Yes. So sometimes you might have actually, parked an expense in your books of account because Companies Act allows you to treat it as an expense. However, parallelly, when you look at the Income Tax Act, income tax authorities might be saying that we don't allow it as an expense in the current year. You might actually take a deduction of it in 5 years. Yeah, for example, the research expense, Income Tax Act says that you can take its deduction in 5 years. So what you do is you take the total amount and show 1/5 of it as an expense in your Income Tax Act P&L. Right. So you will notice that when you are doing this, the total amount of profit as per Companies Act as well as the Income Tax Act varies. Right. And due to these differences in profits, actually, the amount of tax that is calculated as per Companies Act and the amount of tax calculated as per Income Tax Act will be different. Okay, so let me just open an Excel book for you to give you an example. I'll take a simple example. I'm not sure my Excel is open. Let me know when you're able to see my Excel workbook. Okay. So let's assume that we have a revenue of 100 in book the books. Suppose we don't have any difference here. Okay, we'll only make a difference 10s. Suppose we have other expenses of 50 here, and suppose, for example, Income Tax Act is saying these all are allowed in Income Tax Act also. But there is a research expense in addition to all our other expenses. Okay, suppose we are saying 20. What's profit here? 100 minus this, 30. But Income Tax Act says claim only 1/5 as an expense. Okay, so can you see there is a difference in profit now? As per Companies Act, whereas as per Income Tax Act. Okay, so let's assume a 30% or maybe 25% income tax rate. So this is the tax here. And this is the tax here. Okay, so which one is higher? Income Tax Act, right? So you're paying higher tax today. However, actually, you have a total expense of 20 here. You will get the benefit of it in the next coming 4 years because 1 year is here actually. So since you will be able to get the benefit in future years, this is a deferred tax asset. Make sense? Now let's try to reverse this example. Suppose actually I recorded some expense here, or maybe let's keep this example here, and in other expenses instead let's try to see depreciation. Okay, so normally what happens is Companies Act actually prescribes some depreciation rates which are minimum depreciation rates. You can actually charge higher depreciation to your assets, but minimum rates or minimum useful lives have actually been prescribed in Companies Act. So Income Tax Act actually gives you higher higher depreciation rates. So it's quite possible that for an asset that you are charging 50 rupees depreciation, Income Tax Act is actually saying 70 rupees depreciation. Usually it happens. Usually this only happens. Income Tax Act actually gives you higher depreciation rates. Okay, so can you now look at how the profits have changed? Now, Companies Act is showing higher profit. So as per Income Tax Act, you're actually paying less tax than you were supposed to pay. Right? So this is now, since this is in minus, this is now deferred tax liability, because in future you will have to pay this tax. Make sense? So this is the basic concept of deferred tax asset or deferred tax liability. So the crucial thing here to understand is that if you are going to get a benefit in future years, you will make a deferred tax asset. And if you are going to have to pay in future, you'll have to make a deferred tax liability for that.
So taxes are paid as per the Income Tax Act. The tax act we calculate through the Income Tax Act balance sheet.
Yeah.
Okay, and whatever difference there is, we record it in a Companies Act, like balance sheet as per the Companies Act.
So what happens is, let me go one step further. So what happens is, this is your Companies Act books of account. This was your P&L. Okay. So as per your P&L, you actually calculated a 7.5 tax, but actually as per Income Tax Act, you have made a payment of 6.5 only. So what you will do is, this will be your current tax. Then you will have a deferred tax. This will be your deferred tax. Okay. So net you will have an impact of 6.5, so that your cash flows also match with your financial statements.
Okay, okay. So okay.
So
Yeah,
if you will actually pick up, so if you actually pick up a financial statement now, you will see these two things at the bottom. There is one current tax and then there is one deferred tax. The net of this is actually the impact as per Income Tax Act, the actual payment that you might have made.
Okay. Thank you.
Okay, so it's shown like this. So this is actually a parallel, set of accounts that you prepare. You're not supposed to file these with Companies Act. For Companies Act requirements, you're only supposed to prepare as per Companies Act rules. But since Income Tax Act also is a, reality that we are into, we have to only in Excel maybe or somewhere, so that it goes on year. So it happens that, this is 2020, then I'll pick up balances from here, and for next year I'll prepare for 2021. I'll keep the same format, pick balances from here and start here. What was my DTA or DTL in previous year? So I'll link it to here and then do my further calculations. Make sense?
Yes.
So any questions? I believe with this number example, I think it should be very clear now, but still, any questions? Take a moment, try to understand, because this is a very crucial concept and there is nothing confusing about it. But still, sometimes, it happens that people are not able to understand whether to make a deferred tax asset or whether to make a deferred tax liability. So I have given you the ground rule. Just think of it from this perspective. Like if you're paying higher income tax as per Income Tax Act, and you'll get a benefit in future, you will have an asset in place. And if in future you're supposed to pay, you will have a liability in place. Great. So should I move forward now? I can come back to your questions if later on you can, you have any questions. Okay. Okay, so let's read through the definition here also. Deferred tax asset represents accumulated value of deferred tax income that will be utilized in future. Deferred tax liability represents accumulated value of deferred tax expense. Make sense? So whatever expense you are going to incur in future will result in today's liability, that is deferred tax liability. And whatever benefit that you're going to have in future because of this deferred tax situation, that will be your deferred tax income and would result in a deferred tax asset today. Okay. Next up is investment in associates. So whenever you look at a balance sheet and you look at an item which is there saying investment in associates, try and understand it from the perspective that it is actually representing a share of net assets of an associate that belongs to the parent company. Okay, so this is actually the kind of accounting that is done for investment in associates. Okay, so the share of net assets or share of the profits that belong to the parent company are actually added to the cost of investment year on year. So if you might have made an investment of suppose rupees 1 lakh in an associate, and you look at the balance sheet, you are actually able to look at an amount of 2 lakh rupees. Okay, so try and understand that it actually includes the share of net assets that belongs to the parent company. Fair enough? Next up is minority interest. Okay, so when we say minority interest, it actually is also called as non-controlling interests. So if you ever come across minority interest or non-controlling interests, these are one and the same thing. Okay, it's only in India as an IFRS, it's called non-controlling interest, and in Indian GAAP, it's actually called minority interest. So guys, minority interest or non-controlling interest actually comes into picture in a consolidated financial statements only. You will never ever see a minority interest or non-controlling interest in a standalone financial statement. And why is that? Any idea, any thought about it? Anything that we know about minority interest or non-controlling interest?
It's about the majority of the entity, correct? Sorry, means if as the example you have given A, B, C, D. So maybe A have their own majority, B have their manager non-current liability. So they cannot show in their each balance sheet. So only when the group shows, then only it will come. like that.
When you say non-current liabilities, what does that mean?
It means the majority of the company which have the interest.
Uh-huh.
So if I'm not sure how to explain that in another way, which I have read.
No worries. No worries. Okay. Anybody else? Okay.
So is it like that when if it's a parent company and it's a consolidated financial statements, so it's 100% in all, including all the subsidiaries and parent company. But since some interests are held by other external shareholders, we show that this is person. So we need to show that how much interest is owned by which person in which subsidiary.
Yes. Yes. This is precisely that. Very well explained also. So yes, this is what is minority or non-controlling interests. As the name suggests that this is non-controlling interests. So what happens is that suppose A has 80% of the ownership of its subsidiary. Okay. But what you connect a balance sheet in your books, you just not do that. That 80% is included in your financial statement by line addition. Shown separately in your financial statements. So that balance is actually represented to give an idea that whole of the ownership is not with the parent company, and how many of the net assets or how much of the net assets actually belong to external shareholders who are not the controllers, who are not the controlling parties of the parent company. That is why it's called non-controlling interests or minority interests. So that's actually just a value that is given. They are not real people who are those are not shareholders. It's the value of the company that belongs to the external shareholders and which have not been consolidated. So it's for the purpose of stakeholders' knowledge that this amount is actually belonging to the third parties and it's not held by us. So as the definition also reads here, minority interest in the balance sheet refers to the share of assets of subsidiary company that belong to external shareholders. So that is called the minority interest or non-controlling interest. So is it clear? Okay, so what I'm trying to say here is, suppose you are the parent company, okay, and you have a subsidiary, okay. So how do you say that a company is your subsidiary? You should be able to exercise control on that company. That is how you say that that company is your subsidiary. Okay. Now there are several ways in which you can determine the control. For that, there is a whole standard around it. You will have to read that in detail to understand how do we say that there is control or not. But let's assume that we have a control on B, which is in our example a subsidiary of A. Okay, but now since I have only 80% of the shareholding, I have the control, so it's my subsidiary. I can consolidate it, but I have only 80% of the shareholding. So it will not be fair to include all of its assets in my financial statements, which would definitely mean that it's a 100% or wholly owned subsidiary of A. There'll be there'll be an incorrect accounting as well as unfair to all the non-controlling interests or to the third parties, right? So what you do is you include all of the balance sheet of B into A, and then you calculate this non-controlling interest and show it separately in your financial statements. Make sense? Or you need an example? I don't want to confuse everyone with example. That's why I'm not giving an example. Okay, let me try to give one simple example. Okay, if other people have already understood, don't listen to me.
Sakshi,
Okay.
one question here.
Yeah,
Hello.
please. Yes.
Why do we show this minority interest in our balance sheet when it doesn't belong to us?
Okay, so my example will explain this. Just look at the
Okay.
chat box to right here. Okay. A is parent, B is subsidiary, B is having a share capital. Okay, think of it as equity of rupees 100. Okay, now A is holding only 80% of B. So in A's books, when you look at A's financial statement or separate financial statement, you will see A has made an investment of rupees 80. Make sense? 100 rupees for equity share capital hai. You will have to pay 80 rupees to B to acquire 80% shareholding. Make sense? So against 80 rupees, I'm saying that it owns equity of 80 also. Now suppose when we are going to consolidate the financial statements of A and B, what I'll do is I'll add all the items line by line. Okay, so if suppose A has 100 rupees of assets and B has 90 rupees of assets, total will be 190. Similarly, other liabilities also will be added line by line. Okay, but an important aspect here would be the knocking off investment with equity. So when you will add all the things line by line, an important aspect here is to knock off the investment with equity. So when you look at a consolidated financial statement, it will be very stupid if you will show an investment of rupees 80 and an equity share capital of 180. That doesn't make any sense. You cannot make an investment in yourself. Right? So with that logic, you are actually supposed to knock off the investment value with the equity of the subsidiary. But if you look at that, you will see that B has an actually equity of 100 while you have actually made an investment of 80 only. So where are you going? That 20 rupees is actually minority. That's why you're required to show it also. Technically also, principally also. So the entry that you will make is, so equity capital is actually a debit balance. Do you understand that? So when you will post an entry in your books, you will debit equity capital by 100 you will credit investment by 80 and you will credit minority interest by 20. Oh, sorry, that's a typo. Credit investment by 80, not 90, because you have made an investment of 80 only. Make sense? Suppose this is A's balance sheet. Suppose this is B's balance sheet. On the asset side, there is an investment of 80 rupees along with all the other assets. Suppose 200. So there is an equity of itself, suppose 100 rupees, and there are other liabilities. This is 280. I'll have to balance it. This will be 180. Suppose this is an imaginary balance sheet of A. Let's try to make B's balance sheet also. I'll not complicate it. Let's try to keep other assets as 100, equity as 100. Suppose there is nothing else. So we have a simple balance sheet. Now let's try to consolidate it. You'll have to add all the assets line by line. Typically, this is your consolidated balance sheet. Okay, but then you are actually supposed to make some eliminations. So eliminations are actually adjustments only. We just call them eliminations for the purpose of consolidated financial statements. Okay, so for investment is a debit balance. So the entry that I posted there, so equity knocking you will have to do. So the entry you will post is equity share capital debit by how much? You'll have to remove this equity of B from here. Why? Because you cannot have the equity share capital of B also in your books. You own 80% of this. So the ground rule is that at the end of a perfect consolidation, only the equity of parent should remain. So if you look at a standalone balance sheet and a consolidated balance sheet, the equity of parent should only remain. It cannot increase. So that is a perfect consolidation. So equity share capital debit by 100, credit the investment. How much is the investment? 80 rupees. Balance. Since balance is not owned by you, minority interest, credit 20. Entry is balancing, right? Let's make this adjustment here. Investment, and there will be a new item, minority. So that is why you have a minority interest of 20. Similarly, it's done with other reserves or other net of your assets also. Make sense? Guys, is minority interest understood, or should I explain any further? I believe with this example, it should be very clear now. So can you see why minority interest has come into picture now? Yeah, because if you look at this entry, you can see that only 80 was held by us in investment. 20 was not held by us. That is why we had to park it to minority interest. Same thing happens with other reserves also. And the total of all those reserves or all those adjustments comes out to be minority interest in your consolidated balance sheet. Somebody asked me the question that if it's consolidated balance sheet, why are we even required to show a minority interest? Is that question answered now? Hello, hello, hello. Guys, we'll have a break, definitely. I'm assuming you all are hungry now. Answer to me. Is this clear now? Should I move forward?
Yes.
Minority interest
Yes.
is clear?
Yep.
Yes.
Yep, Sakshay.
Great. Great. So we have already discussed all of this in detail. Let me just take you through the slides, and wherever you have a question, you might stop me. Like we discussed, what is goodwill? Yeah, we will take a 10 to 15 minutes break. Don't worry. But I believe I'll take that break around 2. If you need that before that, you might just let me know. Because we have a lot of content to cover. Okay. So what is goodwill? It is the excess of purchase consideration over the total value of assets and liabilities. It arises when one company acquires another but pays more than the fair market value of the net assets. It is classified as an intangible asset. However, it is never amortized. Instead, it is tested for impairment. Fair enough. This is what we had discussed. Any question? Okay, so this is a question on calculation. I would urge all of you to take 2 minutes and try and calculate goodwill with this example. I don't think anybody is calculating goodwill here. Guys, am I audible? Or can you see the screen?
Yeah, you're
Yes.
audible. The screen is visible.
So anybody calculated it yet?
It's 90.
How have you calculated it?
Mm,
Won't it be fixed? I'm not sure. I'm getting confused because it looks pretty straightforward, but will it be 40?
Okay,
Like the
somebody can.
difference between fair market value and book value.
Okay, and did we discuss the definition of goodwill?
Yeah, it
What
is
was
over
it?
the purchase consideration. So, but
Come
we
again?
don't have the information of purchase consideration.
You didn't ask me. I was waiting.
Yeah,
Anybody who's going to
yeah,
ask
I
me
was getting
purchase
confused if it's
consideration.
complete information or not.
That is why I was asking again and again. But who is calculating? Because
Yeah.
nobody has asked me the amount of purchase consideration. So
Yeah.
assume purchase consideration to be 500.
Okay. So then 20.
Okay.
So
So fair market value net assets has been calculated, which is total assets 480 minus total liabilities, okay, which comes out to be 180, or you could have simply picked up the net worth, which is 180, right? So goodwill is purchase price minus fair market value of net assets. So 500 minus 180, 320 is the amount that you have paid. So 320 is the goodwill. You want to go back to your, see, you have a
why
total.
have we received a net worth?
How else will you calculate? So the fair market value,
Yeah.
we have to take the book value. We have to focus on the fair market value. Book value has been given here to confuse you. Okay, so fair market value you have to take. So now think of it from an investor perspective. You are taking up total assets of 480 rupees, fixed assets of 180, 70 investments, 60 inventory, 70 receivables, 100 cash, right? Total assets of 480, but against that 480, you're also going to take up a bank loan of 100 rupees, current liabilities of 100 rupees, 480 rupees assets. You're also taking up 300 rupees is liability also. So how much is the actually value that you are taking up of assets? We're talking about assets, right? So that's 180.
Yeah.
And for that 180, you have actually paid 500 rupees.
Yeah, okay, got it.
Yes.
So that's 320 rupees goodwill that you have actually paid for. Make sense?
Yes, ma'am.
And with this example, it must have been very clear, the calculation part also. Any with this example or question? Or anything that you would like me to explain? Okay, so you all have understood this. Great. Let's just move forward. Okay. So we all might have heard about the term fixed assets, right? What are fixed assets? So let me tell you, there is an important aspect to the term fixed asset. Okay, when we say fixed assets or tangible assets, we actually refer to those assets that a business is using to generate economic benefits, to generate income, or which is actually required to run the business. Okay, why I'm saying this is there is an important phenomena that has now come into picture with all the accounting improvements, developments, Ind AS, IFRS, US GAAP in place. So there is an important aspect that is called investment property. Okay, so now assume that you have two buildings. One building you are using to run your own business, which is a part of your administration or the stuff. That building will actually be termed as a fixed asset for you. While the other building, you're not using that building to generate economic benefits for your company, or you're not using that business to run the business. You're not using that building to run your business. You have actually given that building on rent, and you are only counting on the capital appreciation of that building as well as generating rental income from that building. So that building will not be your fixed asset. It will be your investment property. Okay. So that is why there is a...
Repeat this. I missed out on the point that you were making about the investment property.
So what I'm trying to explain here is that suppose you have two assets, okay, and one of those assets is actually being used by you to generate economic benefits for your company or your business, while the other asset is there just to earn capital appreciation or rental income. We took an example of buildings. Suppose you have two buildings. One of the buildings is being used by you as your office to run your business. That building will be termed as a fixed asset or a tangible asset. While the other building that you're not using to run your business, you're only giving that building out on rent, while leasing out is not your actual main business. You're not into a business of leasing out assets. That's not your core business operation. Okay, so you have given that building on rent, you're getting rental income, or you have a plan to earn capital appreciation on that building that you might have purchased it today for 1 crore, and you're thinking that 10 or 20 years down the line it'll get a value of 20 crores. You're actually counting on that, and for that purpose only you have made that investment in that building. That asset, that building will not be your fixed asset. That asset will be your investment property.
Okay, understood. Thanks.
Yeah. So I also try and understand that the concept that I have just discussed or just highlighted here, this is prevalent under Ind AS and IFRS. Under Indian GAAP, there is no distinction. So this is where there is a difference between the two. You might be able to appreciate the difference also, that the purpose of the two are very different. But in Indian GAAP, there is no such thing called as investment property. So all of the assets that you own or that you have bought or you have taken on finance lease, those are being shown as fixed assets only. So that's an add-on point that I've just given you. Okay, so don't confuse it. If you're with Indian GAAP, all the assets are tangible assets and fixed assets. But with Indian GAAP or IFRS, you have to distinguish between investment property and fixed assets. Okay. So like I said that assets are mostly recorded on cost only. So yes, all your fixed assets are recognized as historical value in the balance sheet, which is the total cost that might have been incurred to bring that asset into place. Depreciation. These fixed assets are actually required to be depreciated every year. The assets are shown in the balance sheet at their net value. What is net value? It's gross value minus accumulated depreciation. So guys, we all fairly understand what are fixed assets. Can you connect it to some of your accounting convention? Why do you think we record fixed assets? Why don't we charge it off to P&L? Suppose I have purchased a 1 crore rupees machinery today. Why don't I just charge it to current year's profit and show the net profit or net loss, whatever the situation may be? And why do I have to record it as an asset in my books? Or why exactly I am at
Because
historical
it is
cost?
hello.
Yes.
Because it is not related to this year, it is related to other year also. So we have not discussed, we have not recorded P&L because P&L is related to this year only, na. Balance sheet is related to, balance sheet is going to opening balance in next year also.
Yes. Anybody else wants to try? This is a very important point that you have highlighted. Sorry, your name?
Gupta. Prem.
Sorry?
Prem
Prem.
Gupta.
Okay. Prem, you have highlighted a very important point here. Anybody else who wants to connect this to one of the major accounting concepts that you would have discussed yesterday? So the point that I am trying to explain here is that there is a concept called as going concern. Yes, Pallavi, precisely, bang on. Going concern concept is there due to which we actually record our assets in the balance sheet. Okay, so the two things here. One is the going concern concept, another is the matching concept. Okay, so Prem has highlighted the matching concept and Pallavi has highlighted the going concern concept. Because of the going concern concept, we are actually recording assets in our books and depreciating those assets over the life of that asset. Yes. Why? Because we are simply assuming that our business is going to continue into a foreseeable future. It's not like we have just started the business and anytime soon it might get shut down, sell it off. We don't have those intentions. We are assuming a going concern concept. That is why we recognize assets in our books and depreciate them over the useful life of that asset. We don't use a life of the business for that, because we don't denote a life to our business, right? Because going concern concept is in place. Second is the matching concept. The matching concept says that whatever revenue you have recorded, cost matching to that revenue should also be recorded in the P&L. Right? So whatever cost that you have incurred to earn that revenue, that also should be recorded in your P&L. So since in my example, when I said that I have paid 1 crore rupees for that machinery and the life of that machinery is actually 20 years, I should actually depreciate that machinery over 20 years and should not just park it to the P&L for the current year, because that machinery is actually going to help my business for upcoming 20 years, not just 1 year. So whatever revenue I earn in this year and in the next year and the next to next year, cost matching to that revenue should only be charged to the P&L, and that will be only depreciation or the whole cost of the revenue of the machinery. Make sense? So while we talk about depreciation, there are two ways to charge depreciation. One is the straight line method. Another is the reducing balance method. Let's talk about each of them in detail. So as the name suggests, that a straight line method depreciation would actually result a same amount of depreciation every year. Okay. While the reducing balance method actually means that only a fixed charge is actually made to the value of the asset and not a fixed amount. Okay, so amount gets keeps getting reduced every year. Which one do you think is better? The reducing balance method or the straight line method?
Straight line method.
Okay, why so?
Like we'll charge the, matlab like it is a straight line method. So in this मतलब हर साल एक ही अमाउंट पे कट होता है, हर 1% पे कट होता रहेगा, तो दैट इज अ गुड, like it is a easy format to calculate the depreciation, so that is why.
Okay.
No, reducing balance method is preferable because due to reducing balance method we get a final value of assets at the end of the year. So we getting every year different amount of depreciation. So it will helpful to for scrap value. In the year end I getting the my value, my in the year I get the my assets value. At that time my assets was what is the value of my assets, and it will helpful for final when the assets was get degraded, it will helpful for that also, reducing balance method.
Yeah. Anybody else?
Yeah, one more thing, who said like Prem is talking, no? So in written down value method, there is a chances of errors also, but in straight line the chances of errors will be less, so that is why the straight line method is more taken by the companies.
But due to straight line we not getting our value of assets. Simple we getting only a depreciation in a simple format, in a single way, but due to reducing we getting a correct value of an assets in the year end.
Okay. Let me jump in between. So the basic logic when we say that which one is better, it actually depends on the nature of the asset that we are talking about. Okay, so imagine we are talking about a building. Okay, a building is a building, right? So every year it's gonna give you the same result. Like it's not gonna change, it's not gonna wear off. You might just make same amount of repairs every year and it will be resulting into a same benefit every year. It's brick and mortar, right? It's not going to end up very soon until and obvious it's been built on a very weak foundation or something like that. Not talking about that, but consider a good building. Every year it's gonna give you same benefit. Okay, and contrary to this example, consider a car, okay, or any vehicle that you have taken up for a business. Suppose a van, or suppose a car, or any sort of, suppose a motorbike, whatever. Okay, or suppose a machinery. Okay, now imagine the nature of these two assets and the difference in the nature. Building is going to yield you same benefit every year. You might just have to get it whitewashed every year, or maybe one or two taps are broken or something like that, right? Only a few repairs are needed here and there, and it'll be just giving you the same benefit every year. However, if we are talking about a machinery, in the first year, it's going to give you the exact benefit that it should. However, as you progress with the use of that machinery, it's going to result in more number of repairs than it was in previous year. Okay, so suppose you have just purchased a machinery which is supposed to give you 90% efficiency. Okay, so in the first year it's definitely going to give you 90% efficiency because you've just bought it. In the next year you will be required to make some repairs to it, right? And it's quite possible that it still gives you 90% efficiency. But in the third year, it's definitely gonna drop down to probably 85, not even 85, then to 88. And it's going to demand more of repairs, maintenance at least. In the fourth year, definitely it's gonna drop further. Yeah. So try and look at it from the nature of the asset perspective. A machinery would require more and more repair and maintenance in the later years of its purchase, right? So charging an equal amount of depreciation on the machinery would actually not result in a fair picture. Yes? Why? Because in the first year, you've actually used up the good life of that asset, right? Because it was giving you 90% efficiency. You actually use the machine to its fullest benefit in the first year. In the next year, it demanded some repairs. You could actually extract 90% efficiency again, probably. But in the third, fourth, fifth, sixth, or probably upcoming till 20th year, it's gonna lose its efficiency more and more and be demanding more and more repairs and maintenance every year. And comparing this to an example of a building, it's not gonna demand maintenance every year, and it's not gonna lose its benefit over 20 years to that extent. So when we say better, we actually say that which method is better to the kind of asset that we are talking about. Okay, so for a building, a straight line method is more suited, that an equal amount is actually written off every year from the value of that building. While for other assets, suppose your car or suppose a machinery, it's fair to charge a reducing balance method there. Also, the point that I believe Prem was talking, so I believe Prem had highlighted that in the later years of using that machinery, what would happen is that it would demand more of repair and maintenance. So suppose you are actually charging equal amount of depreciation every year to that asset. Suppose 5,000 rupees you are charging every year. In the first year also you charge 5,000 rupees and there were no repairs. In the second year, you again charged 5,000 rupees depreciation, but there was 1,000 rupees repair also. In the third year, you again charged 5,000 rupees of depreciation, and the repair and maintenance actually increased to 2,000 rupees. Going by that logic, till the later years come, actually you are charging an equal amount of depreciation, but your repair and maintenance has actually gone up higher. So the purpose of charging depreciation has actually failed. The purpose of charging depreciation to assets is actually to make the matching concept come into picture. Right? The income that we are generating matches with the use of that asset. So in the later years, when actually the repair and maintenance is high, it would be very logical that depreciation amount gets reduced so that the total of all these amount actually gives a true and fair picture. So it gives you a benefit of, using your funds judicially also. So suppose in the first year, using this reducing balance method, the depreciation was 5,000 rupees and there was no repair and maintenance. In the second year, suppose the depreciation dropped to 4,500 while there was 1,000 rupees of repair and maintenance. Similarly, in the third year, it dropped to 4,000 rupees or probably proportionately maybe 3,800, and there was 2,000 rupees of depreciation of repair and maintenance. So the total of these two costs actually gives you a true and fair picture of the use of that asset. Make sense?
Yes,
So now
yes.
can we say which one is better? It actually depends on the nature of the asset. Fair enough? Anything that you would like me to explain further? So let's read through the slide also. Straight line method generally used wherever equal write-off provides a reasonably fair measure of the asset's service, as might be the case with a 30-year lease of a building. Fairly explained? If we are using a building, it's going to yield you same benefit every year, and an equal write-off or a straight line method of depreciation is more suited, right? While if we talk about reducing balance method, it is more suited where equal write-off do not provide a reasonably fair measure of the asset service. I think this slide is reading wrong. It says method generally used wherever equal write-off provides a reasonably fair measure of the asset service. It's reading the same for both. Ignore this. Okay, so with the declining balance method of depreciation, the net book value can never reach zero. As a result, management normally writes off the remaining value of the asset in what is known as accelerated depreciation. Can you understand why it says that with the declining balance method of depreciation, the net book value can never reach zero? It's because every year, the depreciation being charged is only a percentage of remaining value. So even if suppose the net value of your asset has reduced to 100 rupees, the depreciation as per reducing balance method would be a percentage of 100 rupees. Suppose what, 10%? Yeah, so only 10 rupees. Still you will have a balance of 90. In the next year, you will have to charge a 10% on 90 rupees, which will be rupees 9. Still you will have a balance of 81 rupees. Right? That's why it says that with the declining balance method of depreciation, the net book value can never reach zero. Since it never reaches zero, you will have to write it off if the asset is no more in use, and we call it an accelerated depreciation. Make sense? Also, the
Sakshi, I
point
have
that
one.
yeah.
Hello.
Yes.
It will be negative, no? Negative also.
How?
Mm,
If it's not zero, how can it be negative?
At the end, if we charge the 10, the value of the asset is 10, and we charging depreciation 11. So there is a
Why
1 rupee.
11?
Yeah. Yes. No, not in a negative. Yeah.
No, even in fact, not in a straight line method, you can get a negative balance, because in a
Yeah.
straight line method, you will
10 years.
divide the cost of asset by the total life, and equal amount of depreciation will be there, right? And in reducing balance method, you have to charge a percentage only. Even then, you will not have a negative balance. So in either of these two methods, you cannot have a negative balance of assets.
Okay. Thanks.
Right, so this is what I was typing here. Even if you have 100 rupees and you're charging a 10% depreciation, you will get net value of 90. Then you will charge 10% on 90. You will get a depreciation of 9 and you will have a net value of 81. Then you will charge 10% on 81. Right? So that's why you will never get a balance of 0 in reducing balance method. Fair enough? Okay, so this is an example, but I believe we have already discussed more than this. because reducing balance method actually considers a same rate. A rate is fixed, amount is not fixed. That is why you can never have a zero amount or a negative amount. Problems with the reducing balance method. The principal problem with the declining balance method is that most people tend to use standard percentages. So like I was discussing about depreciation while we were talking about deferred tax assets and liabilities, I mentioned that Companies Act actually prescribes the minimum depreciation percentages, and Income Tax Act actually gives you very high depreciation percentages. Okay, so what usually happens is that companies just pick up the depreciation percentages given by Companies Act and use them as it is. Okay, so those depreciation percentages are actually the minimum rates prescribed. Those are not the maximum rates prescribed. So companies can actually charge higher rates also depending on the usage of their assets, the nature of the business they are into, right? But what people do is, or what companies do is that they, charge those minimum percentages only. So the depreciation is understated and profits get overstated. And they have an argument that they are charging depreciation as per Companies Act. Those are the minimum rates, not the maximum rates. So this is an exercise on depreciation. You might just take 2-3 minutes to understand this. Post that, let's have a break and let's gather at around 2:30. So there is an organization which buys a truck for rupees 18,000 on January 1st. Truck depreciates at 20%. What is the value of truck after 4 years? So the solution is also here as per the straight line method and as per reducing balance method. You might just go through this and let me know wherever you have a question or if something is not correct as per you. Is this clear? Okay. And do we now understand the basic difference between the usage of straight line and reducing balance method? So mostly you will see reducing balance method being used, but there is no limitation as to the use of straight line method also. It's just which one suits you better. Is everyone here now? Shall we start? Okay, any more responses? Okay. So everybody's back. Great. So, is everything clear till the depreciation topic that we have discussed before our break? Or do I need to explain anything again? Or is there any question, any doubts that I should clarify before going ahead? Great. Then let's move forward. Let me just open the chat box for myself. Okay. Next up is investment. Okay. So I believe everybody understands what is investment in the terms of accounting, in the terms of balance sheet or financial statements. It just means the same thing. Investment is made to earn benefits on that investment. It might be investment in shares, investment in land, building, anywhere. Investment could be anywhere. Okay, you might have purchased bonds, shares of other companies, FDs, right? So all of these are investments and you earn income on those investments. That is why investments are made. These investments in the business increase owner's equity, right? Because you get a return on these investments. How many types of investments have you seen? Guys, what kind of investments have you seen? Anything?
FD, RD,
Right.
and post office. It's also kind of investment.
Right. Those
SIP
are also investments.
fund, SIP mutual
Mutual
fund.
funds. Right. Yes, these are all investments. Okay, so the definition says that an investment is a monetary asset purchased with the idea that the asset will provide income in the future or appreciate. Okay, so it's a monetary asset. Monetary asset means that can be converted into money. It has some monetary value attached to it. Okay, so investment in land is also an investment only. Okay, so if it's a land, it's not going to give you any rental income or other sort of interest income, but its value appreciates, right? For that reason, only people purchase pieces of lands, right? Suppose you have an investment in building. Here again, the concept of investment property comes into picture. Like I was telling you, that if you have an investment in land and building, which is not being used for running your business, it's there just to earn income or appreciation in value, it will be investment property and not your fixed asset. Right? So now we know what are investments. So how are investments recognized in balance sheet? At cost of acquisition plus any incidental charges. Long-term investments are valued at lower of cost or fair value, and short-term investments are carried at cost. This is the basic rule. Like we said, that most of the assets are recorded at cost only. Right? And if you are selling these investments, the profit on such sale or profit on disposal is recognized in the profit and loss statement. Fair enough? So one thing to add here, which is not here in the content. So in India as an IFRS, there is a concept of fair valuation of investments also. Okay, so like I said that we are talking about Indian GAAP here. So Indian GAAP is giving the rules to record the investments at these values, which is the cost of acquisition plus incidental charges. Long-term investments are recorded at lower of cost or fair value. However, short-term investments are recorded at cost only. However, if you look at India's or IFRS, they actually require you to fair value your investments, mark them to market. So if you go back to that limitations slide, the first slide with which we had started the session, you might remember, you might recall that there was a weakness of balance sheet, which was there that the assets are recorded at historical cost, or the assets and liabilities are recorded at historical cost. There is no mark to market and there is no fair value concept. Yes. So somebody had pointed out that what are we doing about these weaknesses? So yeah, India's IFRS takes care of those weaknesses also. They demand you, they require you to record your assets and liabilities on fair values and not on cost basis. Make sense? Next up is inventory. Do you understand what is inventory? Or commonly called as stock? Yes.
Yeah. So actually, in the last slide, there was something in the down name profit on disposal. Is it regarding any investment, or just we have to see when the P&L statement comes?
No. I had explained, I'll explain it again. So if you have an investment, you will keep earning income on that investment, but at some point in time, you might have given a thought to the sale of that investment also. So when you're selling, when you're selling that investment, it's called disposal also. So this is what it's talking about. When you are selling off an asset or disposing of an asset, you might get a profit or a loss on its disposal. And how do you calculate it? It's carrying amount minus disposal proceeds minus expenses incurred.
Okay. Thank you, Sakshi.
It's nothing very confusing types. This is only how do you calculate a profit if you are selling off an asset? That's it. Nothing else. You can get a loss also. But again, so the point that this calculation is trying to make here is that you also have to reduce the expenses from that profit, which you might have incurred to sell off that asset. So for example, suppose you have to sell some stock of paper lying in your godown, which is there for a very long time. Now somebody has agreed to buy that on the condition that you will send off that, or you will courier that stock of paper to their address. Okay, so suppose the cost was 80 of that asset in your books. Suppose that stock of paper was worth rupees 80. You agreed to sell that stock for rupees 100, but you also incurred a cartage or a courier charge of 30 rupees. Yeah, so this definition is trying to explain that you also have to reduce that expense. So actually, if you say that you will, you have sold that stock of paper for 100 rupees, you actually made a profit of rupees 20. But when you reduce the cartage of 30 rupees from there, you will see that actually you got a net loss of 10 rupees. right? So whatever expenses that you incur, which are incidental to make that sale happen, you have to reduce those expenses also.
Okay, thanks a lot.
Okay. Okay, so next up is inventory valuation. So do we understand what is inventory? Commonly called as stock, right? So inventory is anything that we are using in our core business operation, right? So if you're a toy manufacturer, you might have parts that you import, or maybe if you are manufacturing them from the scratch, you might have all the raw materials lying in your godown, the plastic, the rubber that is used in making those toys, all sort of fibers and all. Then there must be some toys which are not finished. They are in the machinery, or some of the parts are lying undone at the moment. That is work in progress. And then you might have some finished goods also, which are packed and ready for sale in your godown. All of these three phases are still your inventory. Okay, inventory is not just your raw material or your finished goods, that is also your work in progress. Okay, so you have three types of inventory. Even if you're in a paper business, or suppose you're making stationery, there might be some material in your machines which is not still completely processed. That is work in progress. There are several methods to measure that also practically. Okay, so there are three types of inventory. Then there are three types of inventory valuation methods also. Okay, now don't connect these three methods with the three types of inventory. Methods are different, types are different. So whatever method you are using that single method for all the three types of inventories. Okay. So the three types of inventory valuation methods are FIFO, LIFO, weighted average method. Okay, so let me just open up an example. Let me go to my Excel book and try to make a number example. Suppose on day 1, you purchased 10 units at a price of 10 rupees each. Okay. So suppose you have purchased some raw materials, or let's keep it simple. Suppose you're in a trading business. Okay. And you have purchased the goods in these 3 lots. On day 1, you purchased 10 units at 10 rupees each, which made a total cost of rupees 100. On day 2, you purchased 8 units at 11 rupees each, which is 88 rupees. On day 3, 15 units at 8 rupees each. Okay, so now you have a total inventory of 308. So as per FIFO, which is first in, first out. Okay, now suppose I'm saying that I have to reduce, suppose 8 units in all 3 examples. Okay, in FIFO, what do you think? What should be the cost of 8 units that I should reduce?
₹80.
8 into
Right.
10.
8 into 10, 80.
Perfect. Yes, because 8 units, and first in, first out, because we purchased this lot, this will be 8 into 10. Your balance would be this minus this. However, as per LIFO, this will be 8 into
8.
So your total cost would be this. And what do you think as per weighted average I should do?
It's 10.5.
Okay, you calculated it.
No, but 10 or 11.
Uh-huh. So how have I calculated the weighted average cost? I am saying the total cost for all these 33 units is 308 rupees. So I divided the total cost by total units. So I got a weighted average cost.
9.3.
Right? Make sense? So this is FIFO, first in, first out. This is LIFO, last in, first out. And this is weighted average, which is the weighted average cost. So for Indian companies, we are not allowed to use LIFO, right? And LIFO is very impractical also. If you see last in, first out, it will result in a very hazy picture. Why? Because last in, first out, if suppose I keep purchasing stock after this also, okay, so at this point I had already eliminated 8 units at this cost, right, which is this LIFO. Going further, suppose now I have to reduce 10 units. Okay, so I might be having 15 minus 8 units at the cost of 8 rupees. Right? 15 minus 8 is 7. Then I have to reduce further 3 units from here. Or in fact, not even that. What I'll have to do is, I'll have to first reduce all the 10 units from here. And this, all of this would remain lying in your books of account. And going further, if you keep purchasing stock after this, you will first reduce the latest purchased units, and then only you can go backwards. So if practically you arrive a point where you're not making any more purchases, any more latest purchases, then only you will be able to go to the last unit that you had purchased. And by that time, it's quite possible that, you know, the stock prices have changed so drastically. Suppose you purchase this as 10 and now the prices are 20. Do you think your P&L will give a true picture? Because actually the market prices have actually risen to such level that now the price of 10 rupees would result in a very untrue picture. Yeah. So for this reason, LIFO is not allowed to be used. We can only use the FIFO method or the weighted average method. Right? Also, try and understand that if there is no inflation, okay, if the prices are not changing, there would be no difference between all these three methods. They would yield the same value of inventory, right? Because in our example, I had taken that I purchased some units at 10, some units at 11, some at 8. That's why the amounts were different as per FIFO, LIFO, and weighted average method. However, suppose there is no inflation, I am constantly in a market where I am getting that raw material for a fixed price of 10 rupees each unit eternally. Do you think it makes a difference whether I'm using a LIFO, FIFO, or weighted average method? No, right?
No, I think so. No.
Because it won't make a difference only. The difference is only due to the purchase price that is changing. See, here is a table also, just to explain that. So for FIFO, if we are saying that inflation is increasing, FIFO is first in, first out, right? So in inventory, the last units would be purchased at highest price. The latest your latest of the purchases would be at the highest price, right? So you'll get the highest cost of all the three methods in FIFO if your inflation is increasing. In LIFO, you will get the lowest of all the three methods. However, if your inflation is decreasing, FIFO would result in the lowest of the cost of all the three methods. Why? Because your latest purchased units will be reduced first. Right? Anyone there?
Yes, ma'am.
Yes, Sakshi.
Yeah, this is clear, right? Because of inflation, there are differences between these three methods. If there is no inflation and the cost is the same for all the three methods, it would result in the same amount of inventory. Okay, so you have to choose wisely while valuing your inventory, which is the accounting policy for that company, whether you're using FIFO or weighted average method. LIFO is not allowed. Okay, so now that we have gone through all the major assets, major balance sheet items, we are now here to understand the working capital cycle. Okay, also known as the operating cycle. So what do you think this diagram is depicting? Or what do you understand by a working capital cycle?
Basically, working capital is used for cash. I think so.
Come again, sorry.
Working capital is I think used for cash, cash transaction in a business for a regular day-to-day working.
Okay. Anybody else?
The amount used for our operational day-to-day operational needs.
Right.
It's like we can easily convert whatever is there into the cash.
Mm-hmm. Okay, and what is working capital? Leave the working capital cycle aside. What do you think is working capital?
The capital which will used to day-to-day transaction, it's called working capital. And
Yes.
current minus current liability is a formula.
Yes. Yes. So that is what working capital means. And this is how you calculate working capital. So working capital is nothing but suppose you're running a business, you have fixed assets in your business, you have investments in your business, which are majorly your long-term investments. You also have some receivables, you have inventory lying in your business, and you also have some cash. Okay, so there is a distinction in the nature of assets and liabilities that are recorded in the balance sheet. Okay, and the distinction is long-term and short-term. Right. Also, we call it like current and non-current. Okay. With the new accounting developments and India's IFRS in place, we are no more writing them as long-term and short-term. We are writing them as current and non-current. Okay. So there are current assets, current liabilities. Then there are non-current assets and non-current liabilities. Okay. And what is current?
Which is easily be convertible into cash.
Right.
In
So for
within
assets, you would say, yeah. So for current assets, it means that which is convertible into cash within 1 year's time or the operating cycle of the company. Okay. Operating cycle is working capital cycle only. Similarly, current liabilities are those liabilities which are required to be paid within 1 year's time, like 12 months, or within the operating cycle of the company. Okay, so here comes into picture that what is a working capital cycle and why do we even need it? We need it for a better presentation of our financial statements, right? To assess what is current, what is non-current. So these fixed assets are non-current, right? Because you don't assume to sell off your fixed assets and convert them into cash within 1 year, right? So suppose you have purchased some stock from a creditor, right? From a vendor, you have purchased some stock on credit. You will never think about selling off your machinery to pay off that debt, would you? No, right? You will not sell off your assets, your fixed assets or your investments to pay off that creditor. You need to have current assets in place to pay those current liabilities. Right? That is why we need to see what is the working capital cycle for a business. Essentially, what that means is the time taken from converting the purchases into inventory, into sales, and then getting cash from those sales. That is the working capital cycle. Let's look at how do we calculate it. So working capital cycle is equal to receivable days plus inventory days minus payable days. And how are these individual ratios calculated? Payable days are calculated as average payables divided by purchases into 365. So whenever you are calculating the average number, average means opening plus closing divided by 2. Okay, so this is how you will calculate average payables. Then you will calculate the cost of average inventory. This is opening inventory plus closing inventory divided by 2. Okay, then you will divide it by cost of goods sold and multiply it with 365. You will get inventory days. Similarly, you will calculate the receivable days. So your working capital cycle would be receivable days plus inventory days minus payable days. Make sense?
Can you please explain again this table?
Okay, so start from the bottom. Okay, so we are calculating the working capital cycle here in days. The formula to that is receivable days plus inventory days minus payable days. Essentially, this means the time taken to convert the receivables plus inventory minus your payables. Right. So if you look at the individual ratios that are presented here, first look at the receivables. Start from the bottom, go to the top. Okay. So sales are converted into receivables. So we are taking average receivables divided by our sales,
Okay.
multiplied with 365, which means that whatever sales we are making, out of that, how much time is taken to convert those sales into money. Okay, so this will be your inflow time. Similarly, we go to the inventory part.
Actually, I have one question.
Let me first finish this table and then I'll come to your question.
Okay.
Because somebody just asked the table, right? So when we come to the inventory part, we are taking the cost of average inventory. So what you can do is take the opening inventory for that period, take the closing inventory for that period, divided by 2. That will be your average inventory that you are holding up for that period, and divided by cost of goods sold. Okay, try and imagine a situation where for the period, suppose we are talking about a 6 months period. Okay, for the 6 months period, you have actually incurred a cost of goods sold of 1,000 rupees. Okay, so you have actually sold 1,000 rupees worth of inventory. You had 100 rupees of inventory on the beginning. You have 150 at the end. So 100 plus 150 divided by 2. Right? Calculate that amount, divide by the cost of goods sold and multiply it with 365. So you will get the time taken to convert that amount in number of days terms. Similarly, you can calculate payable days. And by taking all three numbers, receivable days plus inventory days minus payable days, you will get your working capital cycle in number of days. Right?
Thank you.
So I can understand that while we are talking about only the ratios here, you might not be able to get a better picture in number terms here, but there will be a separate session on ratios. Like I believe the next session is on ratios only. So there you will get a detailed explanation to this for each of the single ratios here. Okay. But still, if you are not able to understand, just let me know. Somebody is asking a question in between. Can you please repeat your question?
Hello.
Hello.
Prem here. Average receivable, it's revenue minus sales return. It's gross average receivable.
Okay.
No, sorry. Sales. It's a sales, gross sales, net sales.
Okay.
मैम वही क्वेश्चन है, ग्रॉस सेल्स या नेट सेल्स आएगी?
आप कह रहे हो ग्रॉस सेल्स आएंगे या नेट सेल्स आएंगे?
Yes. मैं asking question of gross sales and net sales.
Sales return. Oh, so that will be gross sales minus sales return. That will be only net sales, right?
Yes. Okay.
Yeah. So you will take the net sales only.
Net sales. Okay. Thank you.
Yeah. So you have to take the average receivables. Okay. So you have to take the beginning receivable plus ending receivable divided by 2.
Yes. Okay.
Yeah.
Sakshi, one question. Yeah. Hello.
Yeah, please. Hanji.
Yeah. So, in short, can I say that my working capital cycle days are like, for example, if it comes to 20 days, that means in every 20 days, I get my cash from sales or minus my payables and plus my inventory. So I get confused in the actual concept of working capital when we calculate the working capital cycle in days. That
So
what
what
does
happens?
it represent exactly?
Get it, get it. So what happens is that if you're a businessman, okay, think about it from that perspective that you're a businessman, okay, you need some money for your business, but you don't know that how much time you will actually take to use that money and put it into your business and get a return out of it. Now imagine that you need only 100 rupees to put into your business right now because you don't have any money to uh, take it forward, or suppose for any reason, suppose you have only one receivable as of now which is stuck, or suppose you had a huge incoming expenditure on repair or maintenance, okay, you incurred all your money on that, you were not a very good planner, you didn't put any of your money, any of your reserves, okay, so what you did was you ended up using all of your ready cash, all of your ready cash into that repair and maintenance, okay, now you need to go out, pick up some money and inject it in your business and earn returns on that. Okay, this is
Yeah.
a hypothetical situation that I'm trying to make. Okay, now as a businessman, you really need to understand that if you are taking 100 rupees and putting that into your business, how much time you will take to get that money back.
Okay.
You will need that, right? Because suppose in your example, when you said that, okay, working capital cycle is 20 days. Okay, so within 20 days, you will be able to turn that 100 rupees of amount into a whole cycle. You'll be able to purchase, you'll be able to sell, you'll be able to extract money from receivables, and you'll be able to pay back also to the creditors from whom you have made those purchases.
Okay. And then do I again get that 100 rupees back again
You
after
will not
20
get
days?
100 because
But some remaining portion of it, like.
yeah, suppose you purchased all of the 100 rupees worth inventory, and then you might be making a sale on margin only, no? You'll get maybe
Yeah, yeah.
120, maybe 150. So you'll get some money back. Then you can pay off the 100 rupees debt also, and you will get the returns also. So
Okay,
this is
great.
a
Thank you so
hypothetical
much.
situation, but there might be other situations also. So you always need to know what is your working capital cycle, right? So to plan your business, to maybe plan extension, right? So suppose you need some money for something else also. Now
Yeah.
suppose this you did not exhaust all your cash onto that repair and maintenance. You were trying to put some money aside every month for that. Okay, and your working capital cycle is 20 only, right? So with 100
Yeah.
rupees, you were able to get your money as well as the margin back after 20 days. And 10 days are still left in the month. So you will again put 100 back. You can put 25 out of that 50 extra. You'll still get 25 extra.
Okay, great. Thank you so much for clearing this.
Yeah. So this is one of the situations where working capital cycle would help, but there might be other situations also. So you need to know what is your working capital cycle. Then only you can get a grab onto what are your current assets and what are your current liabilities. Right. So you need to have some ready money with you. So suppose your working capital cycle is 20 days. Okay. And there is a long-term debt coming, installment coming in between. Your hand only, because you know that once you put all that money into the business, you'll have to have some money before that 20 days period is over, right? And 20 days
Yeah.
is not very it's an average ratio. You can see that we are taking all the average numbers here. It's not fixed that you will get all the money within 20 days. Sometimes your customers might also default, they might make delays, right? So this is a general ratio. This is a general number that you should have in your mind.
It's an estimation, maybe do
Yeah.
plus minus save days for.
Safe. Yeah. So if we say 20, maybe you can plan for 25 or 30, right? That
Yeah.
case.
Okay.
Okay, so next up is deferred taxes. Deferred taxes, I believe we had discussed in detail. Let's try to read through the slides also, and then whatever questions you have, let's discuss those. So deferred taxes arise due to timing differences between tax laws and accounting rules. Like we discussed it through an example. What are deferred tax assets? In what situations they arise? Right? So here this slide is actually taking an example of the depreciation only. Like I said, the depreciation rate as per income tax is higher than that of the Companies Act. Right? I gave you the underlying principle also. Why? Because the Companies Act only prescribes minimum depreciation rates. Okay. So in the initial years, depreciation for an asset under the IT Act will be higher. So lower taxes paid under the provisions of the Income Tax Act compared to the Companies Act, which accounts to postponing an expense. This difference will be classified as a deferred tax liability. In our example, it was quite clear, right? The income tax as per Companies Act was coming out to be 6.5, and as per income tax, it was coming out to be 7.5. So we were having a deferred tax liability of 1 rupee. Anyone wants me to go back to that example, or is it clear? Okay. 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 So here's a pictorial representation of the concept that in what cases you have deferred tax assets and what cases you have deferred tax liabilities. Okay, so deferred taxes arise due to timing differences between tax laws and accounting rules. Okay, so again, they have taken an example of depreciation only, but on both the sides. So if the depreciation as per Company Act is low and depreciation as per Income Tax Act is high, you're getting a deductible temporary difference. But I think this example is not correct. If depreciation as per Companies Act is less and depreciation as per Income Tax Act is higher, you'll get a benefit in future. Okay, but it's an hypothecation. Okay.
But if depreciation as per Income Tax Act is higher, that means you're paying lower taxes than
As per Companies Act.
company. So it should be a deferred tax liability, no?
I know. I think this slide is not correct. I don't think it's correct because in our example also we were taking the depreciation as per Companies Act as less. It was 6.5, and as per Income Tax Act that was 7.5. It was resulting in a deferred tax liability only.
No, we okay, 1 second. What I remember is that an income as per income tax, the tax was coming at 6.5, and as per Companies Act, it was coming at 7.5. So then it was a one deferred tax liability for one, right? Because we paid 6.5 when we needed to pay 7.5.
This was the example. So what happened was depreciation was higher as per Income Tax Act and Companies Act was less. So this resulted in lower profit in Income Tax Act, no? So we were required to pay less. As per Companies Act, it was higher, it was 7.5, and as per Income Tax Act, this was 6.5. So we actually postponed the expense.
Deferred tax liability for us.
Yeah, I think that slide is wrong. And contrary to this, the example that we had earlier discussed, if I delete this, this was a DTA. Right. So if the expense, which is this, the total expense as per Companies Act is higher, and as per Income Tax Act it is less, we are paying more tax as per Income Tax Act, and we will be getting a benefit of the extra 4 rupees that we had paid. That is a deferred tax asset. The slide is wrong. Ignore that. Okay, so all of this example I've already explained. Does anyone want me to explain it again? The deferred tax asset and liability example that we had discussed. This is everything that we had discussed. Profits as per IT Act are lower or higher. Accordingly, you will calculate assets or liabilities. Okay. An important concept in deferred tax would be of the net loss carryovers. Okay. Anybody has heard about carrying over the losses, the brought forward losses in Income Tax Act? They're allowed to be set off with your profits before you charge any taxes to your income. So what happens is, if suppose you have incurred some loss, which is called business loss, okay, in current year, you are actually allowed to take that loss forward to the next year. If you get a profit in next year, you set off that profit with the carried forward loss. Okay, and if still you get a positive number, still you have some income left, you pay tax only on that net amount. Right. So, do you guys know about this concept?
Yes.
Yeah. So, deferred tax has this concept of
Eight
loss
years.
carry.
I think so. It's 8 year, no? 8 year
Yeah,
till 8
maximum
year.
of 8 years. Yes. So, for business loss, it's 8 years. But however, if you have unabsorbed depreciation, it's unlimited.
Yes. First we have a set of unabsorbed depreciation, then we set of business loss. I think
No,
so. It is a.
vice
I
versa.
think.
I don't know. I'm not quite such a tax expert, but I believe it should be vice versa, because business losses are only allowed to be carried forward for 8 years, no? So I believe first business losses are set off and then only depreciation is set off. Though you can.
I think so. There is a current year depreciation, then business loss.
First is anyway. So current year depreciation is there in the books as per P&L, no? So first, so current year depreciation will be there. But then, are you saying that unabsorbed depreciation is charged?
I think so. Unabsorbed depreciation, then business loss.
Okay, so I'm not a tax expert, so I cannot be sure about it. But somehow I think it should be business losses only, which should be carried first and set off, because they have a time limit attached to it, no? Only 8 years. But
Yes.
okay, I can check and you can also check, because I'm not very sure about it.
I'm also not sure, but I think so. Is an depreciation.
No worries. So that's okay. So here we are only talking about the accounting of it. So in accounting terms, what that means is that you can carry over those net losses only if there is a reasonable certainty that the asset will be used in future fiscal periods. Okay, so 8 years or not, whether you set off unabsorbed depreciation first or business loss first, that is all from tax standpoint, from taxation standpoint. from accounting standpoint, you only have to keep it in mind that you can own it as an asset, as a deferred tax asset in your books, if you are certain that that asset will be used in future. What does that mean? That means that you have a reasonable surety that the company is going to generate profits in future, against which you will be setting off these losses. Okay, so whenever you are you are recording deferred tax assets, and especially on net loss carryovers, you need to see that you have a reasonable certainty that company will be profitable in subsequent years. It will generate profits. There will be some liability. There will be some profit against which you will be setting off these losses. Okay. So next up is contingent liability. I remember in the beginning of the session, when I was discussing the topic of deferred tax liability, somebody has pointed out the nature of contingent liability as deferred tax liability. Okay. So now we have discussed what are deferred tax assets and liabilities. Now let's talk about contingent liabilities. Okay, then we'll be able to understand the difference between these two. So contingent liabilities are potential okay difference between these two. So it's very much possible that the amount of the liability is known. It is estimated. However, it cannot be very much fixed, because once the litigation is over, then only you will be able to know what is the amount which you are actually required to pay, as the court asks you to pay, as the judgment is done. Then only you'll be able to understand what is the actual amount that you're required to pay. But still, there might be some amount that you can estimate, right? Even then, you're not supposed to record that contingent liability in your books. You're only required to give a disclosure of it. Okay. So while deferred tax assets and liabilities are different, they are only liabilities or incomes which are sure that would be set off in future. Contingent liabilities mean that only if the outcome goes against you, then only you will be able to pay for that liability. Similarly, in the case of product warranties, suppose you have sold a product today, you are given a warranty, right? You have an obligation towards the warranty of that product. But however, suppose that item doesn't break in between, doesn't show any signs of malfunction, and the customer doesn't come back, you will not be required to pay for that, right? It's only dependent on the situation or the outcome of that future event in which you have paid, right? So let's look at the definition. A contingent liability is one where the outcome of an existing situation is uncertain, and this uncertainty will be resolved by a future event. Accounting records. A contingent liability is recorded in the books of account only if the contingency is probable and the amount of the liability can be estimated. right? So the ground rule is that the contingent liabilities are not recorded in the balance sheet. They are only disclosed. You are supposed to present them in your financial statements as a disclosure. Okay, you're not recorded. You're not to record them in your balance sheet. Only when the situation is probable and you have fair chance. The court has already, given the ruling, or probably you have not received the documentation, or suppose there is nothing left discussions. Suppose you have presented all your evidences, suppose all the discussions are over, only one date is pending, with you losing the litigation. You say that you will be required to pay, then only contingent liability has crystallized. So the term most commonly used with contingent liabilities is that contingent liabilities have crystallized or not. Okay. So suppose now it's quite probable that you'll be required to pay. So you'll say that the contingent liability is now crystallized, and you'll go ahead, record an expense as a liability in your books. Contingent liability and a deferred tax liability. So now do we understand what are contingent liabilities? So a contingent liability becomes a liability only when it has crystallized. A liability means that you are required to pay. However, contingent liability means that you might be required to pay. Right? So are we clear till here? Any question? Okay. How it is treated in P&L and balance sheet. So like I said, that contingent liabilities are not recorded in balance sheet. They are only disclosed. Okay. So if you take up a financial statement, you can go to the notes to financial statements. Towards the end of those notes, you will see a contingent liabilities note there. Okay. And you'll see all the contingent liabilities that the company has. So those are contingent liabilities. That's why it is not recorded in number terms in P&L and balance sheet. Okay. So only disclosure for contingent liabilities, no treatment in P&L and balance sheet. Okay. Okay. Next up is equity retained earnings. I remember somebody asked the question, the general reserve and the retained earnings, the capital reserve, what is the difference between these two? Okay, so here we are with the equity. What are retained earnings? Like the name suggests, these are retained earnings. Okay, so whatever amount is not used by the business, that is retained earning. Retained earnings belong to the holders of common stock. common stock is equity share capital. Okay, so the investors, all the shareholders, are the owners of all the net worth of the company. They are also the owners of these reserves. So retained earnings actually belong to the shareholders or the owners. How are retained earnings calculated? Revenue, then reduces expenses from it. At the bottom, you reduce taxes from it, right? After all this calculation, you calculate profit for the year or profit after tax, right? So that profit after year, the profit after tax goes to the retained earnings only. Okay, also. So if you have upward revaluation of assets, you might have a share premium also. Then you have a general reserve also. What is general reserve? It's nothing but an amount kept aside. Okay, so the company might have a policy that every year charge suppose 10% to general reserve. So what they'll do is from the retained earning, like I said, profit after tax or profit for the year, they'll say I'll put aside 10% of these profits to the general reserve. Okay, so there is not much difference in general reserve and retained earnings, just the name that is different. Or it might be the situation that general reserve has some notes attached to it, that the general reserve is being created for this use, it's earmarked. Put into a an earmarked fund for some upcoming expenditures or expansion. So for that purpose, several types of reserves are created, but those are all the reserves all form a part of net worth of the company, and they all are owned by the shareholders. Make sense? Who had asked that question? Can you just come forward and try to discuss that? Is it clear to you now? What is the difference between capital reserve, general reserve, and retained earnings? No? So I'll assume that it's clear now. Okay. Losses, share issue expenses that you have. Okay. Revaluation deficit. Suppose you have revalued your assets and you actually got a loss. You will get, you will transfer that also to your reserves. That will reduce the. Then there is a reconciliation of reserve movement reflected in statement of owner's equity. So there's this statement of owner's profit and loss account, balance sheet, and cash flow statement. However, in India's and IFRS, you actually make 4 statements. The extra statement is the statement of owner's equity. or the statement of changes in equity. Okay, that particular statement is actually made to explain in detail the movement in each and every kind of reserve that is there in your books. So let me just go to one balance sheet, then I'll show you the detailed statement of changes in equity. Let's first finish off the P&L items, then I'll take you through a balance sheet to give you a glimpse of how these things actually look. Okay, so now we are done with the balance sheet items and we are up to the profit and loss items. Major items only we'll discuss here. So majority of the items are only revenues and expenses. I'll give you a glimpse of the total expenses also, and you can just look at the sample balance sheet and P&L then. Okay, so revenues, what are revenues? Revenues may result from sale of merchandise, performance of services, rental of property, or lending of money. Guys, this has a difference to it. By the definition revenue actually means the amount that you have earned from the sole activity of the company, the core operations. Okay, so when we say that revenues may result from sale of merchandise, performance of services, rental of property, or lending of money, it means that it can result from any of these services, but these should be the core business operations of your company. Okay, so even if you are money from rental of property, that can be called as your revenue if you are into a business of renting out properties. Okay, so that should be your core business operation. However, suppose you are actually into sale of merchandise and then you're getting an income from the rental of property, it will be not your revenue, it will be your non-operating revenue. Why? Because you have not earned that amount from your core business operation. Okay, so there is a difference. Revenues are only those amounts that you have earned from the main activity of your company. Right? Then you can earn money from lending of amounts also, lending of money. So suppose you're a bank or you're an NBFC, you might actually be in the business of lending out money. Right? So for you, in that case, that would be the revenue. But suppose you have you are a chartered accountant, you have a practice of your own, you are actually giving out services, and then you are lending out some money to someone for a 10% or maybe for a 20% rate of return. They can be typically divided into cost of production or cost of goods sold, selling, distributing, marketing, general and administrative cost, and amortization, registration cost, finance cost, and taxes. So if you look at a profit and loss account, you'll see all these categories of expenses there. Total expenditure was why do do we need the distinguish between these two types of expenses? Why is there even a need for this distinguish? Why can't we just treat all our expenses in the same manner? Mean that not following the mapping concept, since there to be used for multiple future actually has certain amounts, right? We should not have taken it to the P&L. So whenever we say that we are capitalizing, we are capitalizing the expense, we mean that we should take it to the balance sheet and not charge it to the P&L account. While we say, when we say that this asset should be written off or let's charge it off, we essentially mean that it should be now charged to P&L account. Right. A classic example is what auditors usually do is that they look at the repair and maintenance account very carefully. It's a very standard audit practice that while looking at the repair and each and every line item there, to whether are of nature or not, if there is a capital expenditure which has been erroneously charged to the repair and maintenance account or not. Right. So majorly from there, the reviewers or the auditors, they try to assess whether the accounting is correct or not. Right. Any question? Okay. So for income statement also, these are the special line items. I believe we have discussed all of these in very much detail. You can just read through this and let me know if there is something that needs better explanation. So we have discussed all of this in very much detail, the depreciation part, income from associates part, minority interest part. So if you compare this to that similar slide where we had discussed all the topics, we had tax asset and liability there, we had investment in associate there, and then we had minority interest there also. So for all our impact in the P&L as well, right? So the amount that is being recorded in the balance sheet. So like in my example for investment in associates, like at these as investment in associate, and you are looking at the balance sheet with an amount of 200 as investment in associate, that 100 is actually the income portion. So you'll also look at P&L, you'll find 100 rupees there, right? So together 100 plus 100 become 200 in your balance sheet. Anything anybody would like me to explain again? Okay. So still very much clear about all the major balance sheet and P&L items. One important thing about the presentation of a profit and loss account would be the matrix that are being used. Okay, so a normal thing would be to present like total, okay, and the amount would be total profit that you will get. Okay, but contrary to that, you can also present it in EBITDA format. Okay, so this is EBITDA, earnings before interest, tax, depreciation, and amortization. Okay, so so the point that I'm trying to make here is that you can show it either as revenue less expenses as suppose 10. This will be your earning before interest, tax, depreciation, and amortization. Then you will keep on reducing items one by one. Right? You will get EBIT. You've already reduced the DA part here, depreciation, amortization. Finance cost or interest. This is the I part in EBIT. Suppose it's 5. You'll get earning before tax. Suppose tax is again 12 rupees. You'll get profit after tax. Okay, so this is how you show in the EBITDA format. And then there can be a simple other format also, that you have shown revenue as 100. You will show expenses. Okay, and then you will total up all of these here only. Right, you will get profit before tax, taxes, how much? I did something wrong. Depreciation is 10, other expenses is 10. Oh, this is profit before tax.
Yeah, so
Yeah, I reduced it twice. So the amount will be same ultimately, but there are two ways of presenting it. Okay, so let me just open one sample financial. We'll see all the concepts that we have discussed there. Take up your queries, and probably we'll wrap up for the day. Okay, so first of all, let's see. Independent auditors report on the standalone financial statements. Okay, so first we are here at this standalone financial statement, and then this same annual report has consolidated numbers also. See, here are all the major items that we had talked about. Like I said, that we are no longer showing these as long-term assets and short-term assets. We mention them as non-current and current. Okay, so non-current assets have property, plant and equipment, capital work in progress, investment property, like I said, intangible assets under development, financial assets. So this financial assets portion, all of this is as per Ind AS. Okay, so this balance sheet is actually in accordance with Ind AS. So that's why this also has financial assets portion here. Okay. Inventories, financial assets. Now let's go to the P&L part for this same standalone financial statement. See, so they have not used the EBITDA format. What they have done is they have added up the incomes to show total income. Then they have reduced expenses, all of them at once, and showed profit loss before tax. You can also see, like I said, that in the tax expense you will see current tax as well as deferred tax. Can you see? Both of them are here in the P&L. Right? In the balance sheet, there might be deferred tax assets or liabilities. So they don't have any deferred tax assets. Let's look at the deferred tax. So here, it's deferred tax liability. Right? Let me also show you the note for contingent liabilities if they have any. This is the accounting policy that has been given for contingent liabilities and assets, right? See, like I said, that if you go towards the end of the disclosures and the notes to the financial statements, see, these are notes forming part of the standalone financial statements. And in those notes, here is one note, contingent liabilities and commitments. So A is contingent liability. So claims against company not acknowledged as debt, which means that the contingent liabilities have not yet crystallized. So they have only given a disclosure. Demand for stamp duty by collector, demand towards drawal of energy during peak hours by UPPCL or PVVNL. Okay. So all these litigations are pending as of now, and they have not resulted in definite debts. That is why the company has only disclosed them. Other money for which company is contingently liable, which is customs duty. So a litigation might be there for that also. In B part, the company has disclosed its commitments. Estimated amount of contracts remaining to be executed on capital account and not provided for, undertakings, other commitment for purchase of goods and services, right? So this is how all the disclosures are also given. Let me quickly show you the statement of changes in equity. Statement of changes. See, this is a statement of changes in equity. what company has disclosed is all the movement in its equity portion. So one is equity share capital, and then in other equity, there are all the other reserves here. Share application money, equity component, capital reserve, capital redemption reserve, securities premium account, debenture reserve. You can see all the reserves are here. General reserve, retained earnings, foreign currency translation reserve. So all these reserves are presented here, and then each and every single movement in these in these reserves during the year is disclosed here. That is why the statement is called a statement of changes in equity. The closing balance of this statement should tie up with your balance sheet. It says 54,637.52. For 18 and for 19, it is this 57288.82. It's this number plus this number 57279 plus 9, because non-controlling interest is also there. Since this is a consolidated balance sheet, you can see non-controlling interest also here. Right? Anything else that you would like to see in this balance sheet? Or any question that you have from the session? For retained earnings, you can see all the movements have been presented here. The opening balance, then profit or loss for the period, which is here. Then all the other movements have also been presented here, which forms the closing balance. Guys, any questions? From where can we find company's financial statement PDFs? So if it's a listed company, you will be able to download the PDF financial statements from its company's website. Go to the investors tab or investor relations tab, and there you will find the financial statements. Yeah, you can Google it also. If it's a listed company, you will find them very easily. But if they are not a listed company, they are private companies, you will not be able to find them in the public domain. You'll have to download them from NCA. You'll have to pay 100 rupees fee there, and you can download them from there then. Any more questions, guys? Great. So next up, you will be having a session on ratios. So anything that you would like to discuss about today's session, you can ask me today. You can email it to me, or you can ask in the following session also. Okay. So I'll just wrap up for today. You were a great audience. Thank you so much. Good evening.
Thank you, ma'am.
Thank you.
Thanks a lot, Sakshi.
Thanks. Bye.
Bye, guys. Bye.